everyone, Chris Lopez here, and I'm excited about today's episode because it's a little bit different than the usual ones. Rather than me interviewing someone, you get a full episode of me talking about deals. So I want to talk about deals I've invested in so far in 2026, deals I'm looking at, and just talk about the strategy as to why I'm investing in these deals. Now, what prompted this podcast is I am co-hosting the Passive Pocket Summit, which is happening April 30th to May 2nd here in Denver. And there's three topics that I am speaking on. One is around allocating capital. The next is emerging asset classes. And the third one is debt fund due diligence. So I was going around and, preparing notes and thoughts around these, and then start going through my portfolio and deals I was looking at to really help me clarify the strategy and the reasons, because ultimately, like, hey, you talk about this stuff, but where are you putting your money? So I love talking about deals. I know you guys like talking about deals as well. So let's jump into it. So the first area I want to talk about is just, capital allocation. And this is really, a big umbrella for, where do you want to invest in, geography wise, what type of investments, what asset classes, income versus growth. There's a lot of variables in here. But for me, I've been really focused on allocating capital on the debt side. And the reason for that is I want to focus more on income today and also downside protection over upside. So I think one of the best strategies in the market, actually the best strategy, is on the debt side right now. So the three investments I made so far this year, so actually in Q1 of 2026, the first is a Canadian debt fund. The second is a preferred equity fund in Western Ohio multifamily. And then the third is a fund that buys non-performing loans. And these are all, like the, 10, 20, $50 million type multifamily and commercial properties. So again, all three are on the debt side, I'm sorry, two on the debt side, the other one's on the preferred equity side. So all three of those are in different parts of the capital stack. And that has been from like my macro portfolio strategy, that's been the biggest shift for me the last 2 years or so, I would say, is investing a lot more, not through common equity, but on the debt. And actually this preferred equity investment's the first preferred equity investment I've ever made. But again, that is sitting behind the common equity. Now, in addition to doing, the debt side, the three of these, they are not, I would say, directly correlate to each other, right? They're not three hard money debt funds where one's here in Denver, one's in Boston, and one's in Florida, and they're all in the same asset class, same space, but different geography-wise. So from looking at my portfolio and trying to create, non-correlated investments and getting different types of diversification, I wanted to get exposure to debt that wasn't all the same strategy, just in different geographic markets, different sponsors. So these three investments kind of check that box where they're diversified as well in their strategies. All right, so if you're intrigued about where to allocate your capital and what other investors are doing as well, I would love if you came to the Passive Pocket Summit. If you want the details, go to passivepockets.com/summit. And if you decide to buy a ticket, use the coupon code LOPEZVIP, LOPEZ VIP. It'll save you $100. All right. Now, moving on to the second topic here, and that's around emerging asset classes. Now, this is the one I am most excited to come debate at the summit, because I constantly have debates on myself, right? Like, I have one side of me that says, hey, focus on what you know and just do those, one or two asset classes extremely well. Then the other side of me says, hey, create diversification. Go out there, invest in other asset classes, other types of investments, and also take advantage of these macro market trends as well, because I'm a big believer in that so much, of just buying at the right time of the market cycle. So to go through a few examples, now these are all deals I'm looking at right now. One is a distressed multifamily portfolio here in Denver and Colorado Springs. So it's actually bank owned, and the bank wants to unload it. So this is, I've only seen really a handful of deals so far that's like truly distressed so far in Colorado. But I think we're in the very, very early stages, and I think over the next, few months we'll see more of those, and then somewhere over the next like 6 months to 2 years there'll be like a great buying window. So do I just stay focused on that and just kind of be patient and wait? And I know multifamily, I know debt, and great, I can focus on that. Now the other side of me says, hey, let's go out there and create diversification. And when I look at some of these numbers, I'm just like, wow, those numbers are just, they're amazing, right? So for example, I was talking with someone who buys office buildings yesterday, and he is one of a handful of people or handful of groups that's actually buying office right now. But he's bought quite a few properties in like the Denver Tech Center and the Park Meadows area. So just like class A locations. But then the last deal he bought, it was around a 12 cap, and they put 6.5% debt on there. So the cap rate was almost double what the debt. Like, that is just an insane spread that you don't see. Then say, okay, that's 92% occupied. It has good tenants in there, and it's an amazing location. Wow. And from a macro standpoint, right, office is the asset class that's gotten beat up by far the most compared to anything else. And so this is one of the things where, yeah, you can buy things pennies on the dollar. Another deal I looked at, this actually this morning, was a Denver industrial deal, industrial deal in Denver. So it's a really creatively structured deal where it can create cash flow from day one with owner carry. Plus, there's some really great risk mitigation in there as well. And the other thing that's attractive to it is it's a very niche area of industrial where there's low supply and lots of demand. So again, checks off a lot of the boxes. Another deal I'm looking at is a hotel that's being converted to multifamily. So I actually met this operator through the Passive Pockets podcast a couple months ago. And in the last couple weeks, he closed on this old 300-unit hotel in Denver and is in the process of converting it to multifamily. Now, for a couple of years there, I followed a lot of the office to multifamily conversion, and just, very, very few of those deals can pencil out. But I saw hotel to multifamily and said, oh, that makes a ton of sense, right? Because it's already laid out for people to live in there, and it's a much less heavy conversion in construction going from hotel to multifamily. And then he's telling me the numbers. And I will give you ballparks here, but he's buying these at like $30,000 a door, just under $30,000 hotel unit. And once they're done converting it, they'll be in for around like $60,000 to $70,000 per door on a multifamily. So just a crazy low basis for multifamily, right? $60,000 to $70,000 for a brand new, refurbished unit. That is a great basis. All right, the last deal I want to talk with you about is a non-real estate deal, and it's probably the most unique deal. So it's an indoor kids entertainment private equity deal. So I've been following this for over a year now, since when they launched it, and I saw the initial, opportunity to invest. But the reason it's caught my eye right now is a couple. So one is they're about to close the fund, so it's time coming at the very end of the fund. So there's already a bunch of locations that are up and running. There's financials, and they're paying monthly distributions, and they're paying in the mid to high teens. So a very, very healthy cash on cash return. Now the other thing is I've actually used these myself as a father with a couple of young kids. So I've used their facility and quite a few other facilities around Denver, and I've gotten to understand the pros and cons about the facility. I think about it from a business owner standpoint, a liability standpoint, and so I've really gotten my head wrapped around it and truly believe, hey, they've actually one of like the top business models out there for kids entertainment. So there's just a lot of intriguing factors on there that's caught my eye. So again, this is why I'm so excited to come debate this at the summit, because I want to hear other people's opinion on, hey, do you stay focused on the core stuff, or do you go out there and follow some big trends and do create diversification? Now, I'm pretty sure the answer lies, somewhere in between. All right, now the last segment I want to talk about is around debt fund due diligence. Now, many of you know I have shifted a lot of my focus to debt the last couple of years. And I think a lot of other investors have as well, where people just, hey, many are licking some wounds from some, investments aren't doing so well from 3 or 4 years ago. So people want cash flow and they want downside protection. But then it comes down to like, how do you go out there and do DD on a debt fund? So I've gone through a lot of variations on here, but I'd say the biggest shift that I have gone through the last couple of years is going out to their office and doing an on-site audit. And that's just go out there and just verify everything. And the reason I do this for debt funds is I think, making sure there's that proper paper trail, proper financial trail is important, aka because it helps you avoid investing in fraud, right? Or seeing if they're doing fraudulent loans to borrowers, right? And so one of my biggest concerns is just around fraud. My other concern is, are they staying within their stated underwriting guidelines and risk control? Hey, what is their credit score requirements? What are their LTV requirements? And, I can take their word for it, or I can go out there and say, hey, pull up this file and let me see this person's credit report. All right, pull up this third-party appraisal and show me what the appraisal says, right? You can go through and see the paper trail, which helps to, minimize any aspect of fraud, but also gives me peace of mind that they are staying within their stated guidelines on what they'll lend to and what they'll underwrite. So do all that, and go through every single step of checking with the county assessor's office, and then, hey, go open the bank account, show me where the money went out, show me where the money came in. I think it's a great thing to go out there and verify all of it. So as of now, I am doing, fewer investments and fewer deals, but when I do, they are a lot more, thorough like that, and also much bigger deals as well. All right, so that wraps up the deals I've invested in and the deals in my pipeline for Q1 2026. I would love to hear your thoughts. If you're able to make it to the Passive Pocket Summit, then go use that Lopez VIP coupon code. Make sure you shoot me an email or shoot me a text message and let me know you're coming to the event. All right, thank you for listening, and I'll see you next week.